presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello, everyone, and welcome to the Compak Market Update. I'm Mo Ansari, President of Compak Asset Management and host of Market Wrap. This is on August the 2nd, 2022. I'm going to talk a little bit about the Fed this week. I think the market has gotten a little bit ahead of itself, thinking that the Fed might back off from raising interest rates. I think we're a little premature for that. We'll take a look at that. We'll take a look at what the market is, the U.S. economy is, talk a little bit more about the technicals, where we are in the technical analysis, my market meter for a recession, where we are, and the look ahead for the week. So I think we get some big data later on this week and next week, and that should really give us some idea where the Fed is headed next. Let's start with the Fed. The expectation is by the end of this year that we are going to be at about 3.5%. The Fed raised interest rates last week by 0.75%. That was as expected. The market was expecting a 0.75% increase. But where we go from here is the next question. I don't think, even though Powell said that we're data dependent, the market said, okay, the Fed is going to slow down now, and they're going to basically start bringing rates down in 2023. I believe the market has gotten ahead of itself a little bit on that anticipation. I still believe that the Fed is going to raise interest rates between 50 and 75 basis points at the September meeting. That is already in. The 50 is in the market. I think 0.75 or 0.75% is not. It will depend a lot on what the inflation numbers look like, what the numbers look like as far as the payroll. And payroll is going to be the big number that everyone will be looking at this Friday. Expectation is that 250,000 jobs were created, but we are looking at numbers right around there. But if we get a number higher than that, like we did last month, the expectation was for 250,000 jobs, but we got about 372. If we get that many jobs being created, then the economy is still going strong, and the Fed will continue to keep the foot on the brake pedal. That's my feeling. I don't think it will release the pressure off the brakes yet until they confirm that inflation has rolled over and is continuing to drop. A lot of people are saying it's going to take an elevator down instead of an escalator. We will have to wait and see. That is my attitude right now. And I think the market has gone up from 3,600 to 4,100. We're touched on yesterday and starting back off a little. I think we've got some more backing and filling to do over the next week or couple of weeks before we get some more data, before we see what the Fed is going to do. If the Fed is going to do 25 basis points and we do see inflation dropping precipitously, that could have an impact and we could continue higher. But we're getting close to turning back up where we can declare the bear market dead, but I'm not quite ready to do so. Looking at the numbers, again, 50 basis point, which is the forecast right here. This is what the market pricing today is, about a 59 basis point. So that's about what everybody is looking for at the September meeting. Are we going to get 50 or 75? I think that is still dependent on what happens to inflation over the next couple of months. Then the expectation is for another quarter basis point at the next two meetings. We will see if that happens. And again, that'll depend on data, but I think these are baked in. But is it going to be 50 or 0.75? That is the big question. I think we've got the seasonality coming in the market, where the market does have the worst month, usually in September. We're looking at October is where the market bottom comes in usually. I think we might have already made the bottom, but if inflation continues to accelerate, we are going to see some more market volatility over the next month and a half. Looking at the market, we came down, hit this 36.36, and now we've come back up all the way to stock market indexes, come back up to just about these. We need to get above the May-June highs. That's the next resistance. And then we're looking at much higher numbers. But we will have to, we're right here getting close to some resistance areas, and we have to get going on that. The Fed, after the Fed announcement, interest rates have come down. I'll show you the chart on the 10-year where the interest rates dropped precipitously. and they came down quite a bit. But today we had a big spike up in interest rates on the 10-year, where they were up 13.5 basis points. A couple of Fed governors came out and said, well, we're not done with raising interest rates. And again, the market started to realize, wait a minute, we got ahead of ourselves. And that's what the market does. In May, everybody's saying, oh my God, the world's ending. This is it. A recession is coming. I believe a recession might come, but it'll be a mild recession as long as unemployment does not go up. As the old saying is, that if your neighbor loses his job, it's a recession. If you lose your job, it's a depression. I've changed that now because we've got so many jobs out there. Now, if your neighbor loses his job, it's a slowdown. If you lose your job, then it's a recession. But that's not happening out there right now. There's still a tremendous amount of jobs. That's why this Friday's unemployment number is going to be critical to see how much strength there is in the job market. Is that starting to roll over? Are companies starting to lay off? Or at least they are starting to not hire as many people, but you're not hearing about a lot of layoffs right now. Looking at the Nasdaq, since for this month, we are up so far. Performance market is down 12%, S&P 9%. We've had some nice gains in the markets overall over the last couple of weeks, but is it done going down? We'll have to wait and see. U.S. economy, we're starting to see personal expenditures are starting to slow down a little bit, but we're still spending a lot of money. People are still spending, even though we've used up all the savings from COVID that people had because they were forced to save because people were not going anywhere. But now we're starting to see people dip into their savings. They're starting to put more expenses on their credit cards, and they're saying, well, as long as I have a job, I can go back and pay it off. But I think that is going to slow down if the job unemployment rate starts to go up. Business investment, you can see that is negative. Real estate is coming down. It's slowed down. I think we've pulled forward a lot of the appreciation. We are going to see a slowdown in recession, but I still feel 5-6% mortgages are here to stay. I don't think interest rates, once they do go up, hit the 3.5, 3.25 Fed fund rate. After that, everybody's expecting the Fed will start lowering interest rates. I don't see that. I think the Fed will maintain this interest rate policy for a long period before the start, unless we go into a deep recession, unemployment starts to rise dramatically, which could happen, but I don't see that right now with the expenditures levels out there, with the consumption levels out there. Government spending has come down a little bit, but we have a new bill pending now, which is going to put in some spending, but it will also raise some taxes. There's some question about this new bill that Senator Manchin and Senator Schumer have put together, and we will see if it passes. First of all, Senator Sinema has not said that she will support it. They need all the 50 Democratic votes and the vote from the vice president to get it through. But if they do, it does raise a minimum tax to 15% for corporations. And yeah, everybody talks about Amazon. Well, if it goes up from 12 to 15, it does take out a little bit, but I don't think it has a big impact on earnings. Exports have come up nicely. Imports are still down, and real GDP came in negative at 0.9. So now we've got two negative GDP numbers, and that is a classic definition of a recession when we have two negative GDP numbers. But I still believe we're not in a recession now. We could get into a recession later on if unemployment goes up. I think there's a number of factors that we have to look at, and unemployment, I think, is one of the critical factors we have to keep an eye on. Gas prices have come down. Crude oil prices have dropped from 120. They're down to about $93 a barrel. You've seen gasoline prices also back off, which should contribute to, I think, lower inflation numbers. But the Fed does not look at the CPI. They look at the PCE, the Personal Consumption Expenditures Index, PCE as it's called. It came in a little bit lower than the 6.1, came out at 5.8. Their target is 2%. I think we get to somewhere around 3.5 to 4 by the end of this year. If we do, I believe the Fed will say, yes, we still have the 2%. But as you heard on the daily broadcast, on the radio broadcast, I've talked about this for a couple of years. The Fed does want inflation. It will let inflation run hotter than the 2%. Just like Bernanke said, he wants unemployment down to 6%. If it gets below that, he's going to start raising rates. Well, it went down to 5.5, 5, 4.5, 4. They still did not raise rates. They'll let the unemployment number drop. I think the same thing will happen with the Fed, that they will let inflation run hotter, because that is the only way you can devalue debt. And we have piled on a lot of debt over the last decade. I think that's the way you devalue debt, is by causing a little bit of inflation. Earnings per share, not bad. When you look at the earnings per share, they are dipped a little bit, but not bad compared to where we were and all the earnings we've got. Yes, there were some bad ones, but when you look at Amazon and some of the other companies, they continue to earn, while the retail sector, the Walmart and the Targets, are getting hit, which is where America shops. They don't shop at Saks and Neiman Marcus. They shop at Walmart and Target. Those have come down, and we are starting to see consumption fall off, even though retail sales were up, but that accounted gasoline and other prices that have gone up. So people are spending more, but are they spending more on goods and services, or are they spending more on gasoline and food, which I think they are. Looking at the technicals, this is the interest rates. We peaked right here in the middle of June. Then we've dropped off dramatically on the interest rate. We were about close to 3.5. We dropped all the way down. And yesterday we're down to nearly below 2.5. Today we are at 2.74. So it was a big update in interest rates today. I think we go back up to about 3%, and that'll cause some more anxiety in the market as interest rates start to come back up. They'll say, oh my God, the Fed is not going to take the foot. So we go from one extreme to the other, but the reality is somewhere in the middle. And that's what I'm looking at. The S&P 500, I was looking at these highs at 41.77. We got close to that at 41.44 yesterday, got to 41.40, but then we closed negative today. I think if this is wave one, this is wave two, wave three, we could see a fourth wave pullback, brings us down to somewhere around 4,000, or maybe even lower. But as long as we don't get below the 50-day moving average, which is 39.29, as long as we stay there, I think this is going to be sort of sideways here before we start the fifth wave to the upside. Fourth wave down slightly, and then back up towards the fifth wave. That is my looking at each one of these bars that you're looking at, vertical bars, the red ones and the green ones. They're 1 day of trading. This goes back to somewhere around September of last year. Looking at the weekly chart, where each bar is 1 week, this was the March 2020 low. We made a high, a fifth wave top. That's the end of the cycle. And remember, we were looking at 1, 2, 3, and I said this could turn into an ABC correction. Once we create 5 waves to the upside, then we start an ABC correction, and that's what we've gone through. And if we can get above 41.33 and close above that, we did get above that yesterday at 41.44. Today, 41.40 was the high, but we are close. We need to close above 41.33 on a weekly basis. That would be a very positive indication for me as far as the S&P, and that would sort of confirm to me that the S&P is making a bottom. But I look at the Nasdaq and my dot plot to really give me a lot long-term indication when the market has bottomed and top. So let's go and take a look at the Nasdaq charts. Again, this is a daily chart where we're looking at each bar is 1 day. Each one of these lines is 1 day of trading. You can see we made a fifth wave bottom right here. Started 1, 2, 3. Now again, we've got to stay above 11,570. That's the 50-day moving average. If we get below that, this does not become a third wave. It all is an ABC move up, and then we go back and forth until we start a new wave count to the upside. I would not be surprised to just negate this whole entire wave count and just go back and forth for a period of time. Remember, August and September, not good months for the market. So we will see how we hold up in the next couple of months before we really see if we have made a bottom. And that'll also depend on what the inflation data looks like, what the unemployment data looks like, what the Fed's expectation is for their September meeting. This is my dot plot, long-term trend, turned up in April of 2020, right here. When the dots are below, each one of these is 1 week of trading. These vertical lines that you see right here, a 1 week of trading. As you see, the dots were below the market is above. That is a bull trend. When the dots get above the market, which they did at the beginning of this year, then the market is in a downtrend. Well, here's the dot. It's at 12,592. We got to 12,500 today, but then we fell off and we closed at 12,348. So again, We got close to turning up. We can get above 12.6. That would be a good indication. Support is still at the 200-week moving average, which is 12,000, 10,000, about 11,000. So we're sort of stuck right here. I'm not quite ready to declare the bear market dead at this point, even though there are some indications that we might have. But I like to see confirmation. I want to see that bottom in the rear view mirror before I start saying, okay, we've made a bottom in the market. Looking at crude oil, we've come off from 125 where we were in June. We closed today at 93.76. So we're sitting right about the 200-day, even though we closed below it today, which is at, and then we have support at 90.50, the June low. I think the market stays somewhere between $90 and $110 and trades back and forth. OPEC is going to hold a meeting tomorrow. Expectation is they're not going to increase production. Libyan oil is back on the market, so we are getting a little bit more oil. I think the oil is stuck between tight supply because of the Russian invasion of Ukraine and falling demand. The question is, how much will demand fall with the recession coming in Europe, the slowdown in the United States, slowdown in China? How much does demand fall? No one knows. Same thing, supply. It's pretty constant right now, but there's still more demand than supply in oil. And that's why I think we're going to stay at elevated levels unless we see a deep recession here in the United States. Gold, I mentioned last week that around 1,700 could be a bottom. It was the fifth wave looking like. We're now seeing a rally here. Today we got close to the 50-day, which is 1794. We closed at 1778. Gold is going to have a tough time. If interest rates start to go back up, which I think they will in the short term, we've come back to so much so quickly, that'll put more pressure on the gold market. As you know, I've not been a big fan of the gold market over the last couple of years. I still feel there's better opportunities. If you have sold out completely in the market, which you should not have done, but if you did, then you have to look to get back in. I think over the next couple of months, you have to have your list. Pick up the stocks that you wanted to have that are good quality stocks, not the junk stuff, not the crypto, but good quality stocks that you can buy at discounted prices. Some good stocks are selling at 50, 60, 70% discounts. You can start accumulating those if you don't have those in your portfolio. If you have raised some cash over the last 6 months, I am still holding on to the cash that I raised over the last 3 to 6 months, and I'm still not putting that back to work, even though I've raised cash. Depending on what portfolios you have with us, we've raised cash, but we're sitting in a very comfortable situation right now. People sold out in June. Now they're panicking. The market has gone up dramatically from where they got out. They'll get in. Probably next couple of months, the market will go sideways to lower. We'll see more volatility. They'll get out again. Unfortunately, those people always snatch defeat from the jaws of victory. You have to have the long-term plan. You have to have the right risk number. You have to have the right allocation instead of buying this and buying that and chasing this and that. That always works. In the bull market, everybody's a genius. It's how you handle the bear markets, how you hold on to the money in the bad times. Looking at the market meter, yes, I'm getting less negative on the market. I had a 50% chance of a recession. I'm reducing that to about 45% now. I think we could have a mild recession, but not a deep recession. Outlook ahead, we get CPI next week. We get Friday unemployment numbers there for July this Friday. And those two numbers, I think, are going to dictate. They come in stronger on Friday, more than 250,000. I think the market comes down. If CPI comes out higher than 8.8, I think the market goes down a little bit more and goes sideways for a little bit. I think we are going to see more volatility. We've reached a short-term peak. Now we'll see what the pullback looks like over the next few weeks, and then look at that. Is that a buying opportunity, or was this another bear market rally? Those are my views. Those are my thoughts. Those are what I'm thinking. Again, if you need help with your portfolio, give us a call. Just go to compak.com. We will be more than happy to help. Don't forget to download the app where you can get my daily edition of Market Wrap, a 1-hour broadcast that I do that is syndicated across the country. You can just go to Market Wrap with Mo Ansari. Type the whole thing in one word, Market Wrap with Mo Ansari, at the Apple Store, and you can download the free app. The broadcast is free, and you can listen to it at your convenience. Again, thank you for joining me today. I will be back with you next week. Until then, good trading.
presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.